It's been just under a week since the US and Israel launched a surprise joint attack against the Iranian regime, which at first decapitated the hierarchy of the Iranian government and is now working to defang the ability of Iran to attack Israel, either via nuclear attack or ballistic missiles. But what looked like a pretty easy conflict in the early going days is now turning into a bit more of a sticky one, with Iran's ability to strike back reaching farther and wider than many anticipated just a few days ago. In this gold market commentary for Friday, March 6th, I'm going to take a look at war's impacts on the financial and commodity markets here in the US. For precious metals, it seemed like it would be better to buy the rumor and then sell the news because metals have come off a little bit since the war started, but I don't think that should be the case. Not yet anyway, and I'll explain why in this update. And that's primarily because we're seeing a surging oil price, which is now threatening the global economy. We're seeing stocks tumble, we're seeing the US dollar rise and yields rise. Meanwhile, metals have been pretty steady the last couple of trading sessions, despite a rising dollar and rising yields. In other news today, we got a new jobs report for the US for February, and it was very weak. So employment's down. Meanwhile, inflation has been holding its head up, and now we've got higher oil prices, which will transmit more inflation into the global economy. And that's a classic recipe for stagflation. And it all hinges upon the duration and the depth of this war and how much damage it might actually cause, in particular, to the oil infrastructure in the Middle East. And that, at this point in time, remains a big unknown. Let me get into the precious metals charts so we can review what's happened, especially since the war has now begun a little under a week ago. This is the COMEX gold futures chart in 4-hour bars going back to January 19th, which shows you the big run up in gold leading to the blow off top at 56.26 and the subsequent sell off that resulted in the big bottom at 44.20. And we had a bounce since then that took gold up to about 51.15, and then a subsequent sell off that took gold down to 47.80. So I've got some trend lines here on the chart that I've defined. The first one that's important is defined by letter A at the bottom of the chart at 45.82. That was relevant when gold was looking weaker, but I don't think it's relevant now. In fact, I do think 47.80 will probably be a real support for gold going forward. Between 47.80 and the next lowest point on the chart, labeled number 1 at 49.04, I've connected those two and extended that out to today, what I've labeled trend line C, which is, I think, the most important trend line, the rising trend that we've seen since those two bottoms. In the meantime, at the top, we've got upward resistance as defined by trend line B at 53.35. So these are the numbers that are the most important for gold right now. 47.80 and then 4,900 for support and resistance at 53.35. Now let's tighten this up and I'll explain some of the other things that I'm seeing on the chart. This is the same gold futures contract chart, now tightened up a little bit to February 6th, which is a 20-day chart in 1-hour bars. Now what I've lost is the ability to see that previous bottom at 47.40, but you can still see the rising trend line C, which goes through the last bottom at 49.04, which is actually about 48.80 in earnest. 49.04, labeled number 1, that's when the media around the world started to report how significant the U.S. military buildup was becoming in the Middle East, which kind of caught everybody by surprise. Trend line B is that upward resistance line at 53.35 that goes all the way back to last December, which is the resistance gold hit before we went into January in that really big top. In the meantime, we had resistance for gold at D at 51.15 that we've moved over due to the military buildup. Number two is when the US and Israel attacked Iran. At that point in time, gold had gotten to 53.16 on Friday's close a week ago. The war broke out on Saturday. When the markets reopened on Sunday going into Monday, we peaked at about 54.40 on Monday, bounced, sold off a little bit and then bounced. And then we sold off on Tuesday, which leads to number three, which I'll call the global liquidity sell-off. And what tends to happen when there's uncertainty rising in these markets, like we've seen, substantial uncertainty, and the oil price starts to rise, traders don't have any good sense of which direction the market's headed in. This is a lot of speculators in all markets. So what do? They take their positions back. If they're long, they're selling. If they're short, they're buying, and they're going to cash and going to the sidelines till some further direction is established. And that's what number three is. That's when stocks took a big tumble in the US and precious metals got sold off in sympathy as part of the liquidity event. Since then, we've been basing a little bit under 51.15 at 50.60. But the week's high this week that we've seen since that sell-off of the liquidity event is 52.10. So right now, gold is trading between 50.60 and 52.10. If we drill down a little bit more closely, you can see this more obviously. So right now, the most important support for gold is at 50.60. And I don't think the world is going to let gold get much under $5,000 in the current environment. In fact, I think the bias is now towards the upside. And we've got short-term resistance at 52.10 and then major resistance at 53.35. I think we'll go in choppy trading, but we'll bias to the higher side of this range as time passes. And that has a lot to do with what's happening with oil and the uncertainty that the war that's dragging on will create. And we'll talk a little bit more about that as we go through the update. Let's take a look at silver. Here's a same long look at silver going back to January 19th in 4-hour bars, which shows the top at 121.78 and the bottom after we bounced twice on a sell-off and a rebound at 64.05. Now, what I've done is I've connected that bottom to the next short-term bottom at 72.20 labeled 1, and those have created that upward rising support line that once again I've labeled C. But in the big picture, you've got a bottom for silver at 70.10 at the support line labeled A and resistance at 95.68. That's the big trading range for silver in the big picture. But I think in the short term, it's actually much tighter. Let's drill down a little bit more closely. So if you look at that trend line D, which starts about a third of the way off from the left, that was upside resistance, and silver was leaking and looking weak when we got to point number 1, which was when the U.S. military buildup was announced in the media around the world, and silver started to catch a bid. Silver ran all the way to just under $95 at the close of the market last week before the U.S. and Israel attacked Iran. When the market reopened, we ran up to 97.30, and like gold, we had a little sell-off, then a little pop higher, and then a bigger sell-off on Monday on profit taking, which led to that liquidity event, number 3 that I've labeled, where there was a lot of selling in the U.S. markets. But support has been held on throughout this volatility at that rising trend line C. Now, I've also got a trend line labeled E at 82.75 that goes back months, which is now becoming support. It was resistance, but now it's becoming support, and shorter term resistance at 92.04. So let's drill down just a little bit tighter. And I really think the key numbers here for silver in the current market are 79 for major support to 82.75 for a little bit higher support, and then resistance at 92.04 and resistance again at 95.68. I think the bias will be towards the higher side, but unlike gold, which is 90% monetary metal and 10% commodity metal. Silver is about 50-50 monetary metal and commodity metal. So if we go into a global economic slowdown that's driven by the uncertainty of this war and the higher inflation that a rising oil price will transmit into the global economy, we could see silver go through some weaker bouts along the way. So I expect some choppiness. I do think silver will look very attractive under $80 to buyers around the world, and especially at $75, where we bounced off of twice already along the way. So I think the bias towards silver will be higher, but it will be choppy. Closing out today's trading with gold just a little over 51.73 and silver just a little over 84.50, when I pulled this chart about an hour before the close, that brings the gold to silver ratio to 61.21 to 1, or just under what I've labeled for years as the equilibrium point between the two at 62.5 to 1. So I think the gold and silver are fairly valued relative to each other in the current market. Let's take a quick look at platinum and palladium. 6-month candlestick chart for platinum. I defined support at 1980 about a month ago and resistance at 23.25. We continue to remain range bound between these in very choppy trade. Platinum closed today at 21.95. That candlestick is not on this chart, but it's right in the middle of the range. And palladium, we've got a similar chart with support at 1600 and resistance at 1875. We remain range bound with the market closing today at 1695. A little bit more towards the bottom of the range, but closer to the equilibrium point. So they're range bound, and I continue to expect to see platinum and palladium choppy within their bigger ranges. And that brings us to oil, the most important commodity in the world right now. Now, this is a chart that shows where oil peaked when Israel and Iran had their 12-day war last June at just under $75 a barrel in the West Texas Intermediate crude market. Oil was about $67 when Israel and the U.S. attacked Iran, and that ran up to $81 as of yesterday, March 5th close. But we've seen oil spike even farther today, up another 10 just today. And this shows you how that run has gone, with now oil going from $67 to $91 as we close out the market on Friday, March 6th. And that's because Iran is fighting back. This is a fight to the death for the Iranian regime, and they're going to throw everything they can at us to preserve their power. And they're going after oil infrastructure now around the Middle East. It was reported today that the U.S. took out a major Iranian oil facility on the Strait of Hormuz. I believe it's right on the water. So this is going to be kind of a nasty drag-out fight, and Iran is putting up a bit better fight than I think we imagined they might, and they're lashing out all around the Gulf to some success, which is impacting the oil market and causing the oil price to spike sharply. Some traders think we could see $100 per barrel oil pretty quickly the way things are going. And it's the higher inflation that is causing stocks to tumble in the U.S., the equity markets. This is a 6-month candlestick chart of the Dow, which has tumbled since the war began. It peaked early in February at 50,500. It was right at about 49,000 when the war began in sideways trade, and now it's tumbled down to 47.5, or down about 6% from the peak and looking weak. And the same thing, and that's part of what the liquidity event was, that red candle that took it way down right after the war began. Not the first one, but the second red candle. And that's the liquidity event that I described earlier on the gold and silver charts. Same thing for the S&P 500, which peaked at 7,002. It's now down to 6740 today, down about 5% since the peak. And we're seeing a similar pattern with the NASDAQ. Peaked twice at just right at 24,000. It's had a lower support line at 21.8 that is coming down to test again. The way things are going, it closed today at 22,387, down 8% since the peak. And this higher oil price will continue to affect the U.S. equity markets, negatively as time passes. Meanwhile, the US dollar is bouncing a little bit from lows that it hit in late January, early February, but it's still range bound, but it is catching a bit of a bid right now in a safe haven move, but it's not transmitting into the bond market like you might expect. This is the 10-year Treasury yield in red, the 2-year Treasury yield in purple, and the Fed funds rate in black going back 1 year. Both the 10 and the 2-year yields were tumbling, but they have spiked in the last week since the war began, about 20 basis points for both of them. This means bonds are being sold. Bonds are being shed. They're not attracting the safe haven bid you would expect them to in this market, which would push the yields lower instead of higher. And we're going through a similar but separate mini bout of a bond turmoil like we went through in April when the tariffs were announced on April 2nd, which took the yield from 4% to 4.5% on April 9th. That was a lot of turmoil in the bond market. Right now, it's pretty contained, but you can see what's happening. Investors are shunning bonds, which are typically a safe haven receptacle when we have uncertainty like we're having. I think this will transmit positively into the gold market as time passes. Meanwhile, we got our U.S. employment report today from the BLS for the month of February, which was supposed to be about 50,000 jobs created. Instead, it was 92,000 jobs lost, a much bigger negative report than anyone expected. When you look at how many jobs were created for the calendar year of 2025, on average, the monthly job creation was about 15,000. Now, January's good jobs report, which came in at 130,000 jobs initially, was revised slightly lower. But with that factored in, the 13-month average got up to 24,000 jobs a month. But now, with today's 92,000 jobs lost, we're back to under the average number of jobs created in 2025 of 15,000 to just about 13,100 jobs over the last 14 months average, which means the U.S. employment market remains pretty weak compared to historical standards and puts the Fed in a bind between their dual mandate to support employment and to contain inflation. Now, the Fed's been leaning towards defending inflation recently and assuming that the labor market would hold up. And this is kind of a poke in the eye at the Fed with that, because the job market is looking weaker than most people imagined it might be at this point in time, substantially weaker with this lower jobs report. So that puts the Fed between a rock and a hard place, and it makes it hard for the markets to try and determine which way the Fed may actually go, whether they'll raise rates to hold inflation in check or whether they'll lower rates to support the employment market. They're caught increasingly between the two. And this is a classic recipe for stagflation: lower employment and higher inflation. And this is the PPI report that we got for January, which shows the producer price index was higher than expected, and by a lot in the core PPI. So this will challenge the Fed over their dual mandate. But remember, the U.S. economy is 70% consumer spending. And when the employment market weakens, that undermines the consumer's ability to spend. And that's why we could see a bit of a global economic slowdown that's driven by the oil inflationary impulse that this oil price spike will push through all markets. And I think it will continue to affect equity markets negatively for the time being, and could help to boost gold, but might put silver into a bit more of a choppy market than most people might expect. So that's my update. If you're interested in the physical precious metals products, this is our Getting Started guide. You can access it through the QR code that features the most widely traded, competitively priced, and most importantly for you, easily sellable precious metals products that there are. Here's our website, what it looks like, amergold.com, where we feature those exact same products, very competitively priced in live, online, transparent pricing we can help you, just give us a call and we'll answer any questions that you may have. Here are our social media accounts where you can follow us. I post charts and comments on X and LinkedIn quite a bit between these regular gold market commentary video updates. And here's our YouTube channel. If you like what we're doing, please subscribe. We'd love to have you as a subscriber. We put out video updates once every week or two, depending upon what's happening in the markets. And here is our contact information. So thank you so much for your time today. God bless our men and women in uniform. We pray that they all come home safely from the conflict and that the losses to life and injury are as minimal as they can be. It's going to be pretty challenging to see how this develops over the next couple of weeks in particular. I wish Godspeed to our U.S. military and hope that this conflict can be resolved as quickly and easily as possible. It could be sticky in the meantime, unfortunately. So best wishes to everyone out there and good luck. Thank you.